And you want to let me know when to start, Len, or is it just fire at will?
Yeah, you can start.
All right, very good. Well, thanks everybody for having me. This is my second time giving this presentation today, believe it or not. So my voice might be a little hoarse, and I know this is a smaller group. The group that I presented to earlier today was about 150 people. So it was a little more formal, but I generally try to like hold off on questions until we get to the end. But just because there is a lot of content to go through, but with a small group like this, I don't think it should be an issue. What I might suggest is if you wanted to use the chat feature to just collect questions there, and if I see it come up, we can address it right away. And if it seems like something that I might be addressing a little later, I might just tell you that I'll address it later. Would that work for everybody if we just use that as a plan of action?
Sure, it's your decision.
All right, excellent. So I guess before you spend the next, I don't know, 45 minutes or so listening to me, maybe a little bit about me. I am a Monroe resident. I live over on the Helmetta side of Monroe, off of Spotswood Gravel Hill Road, if you guys know where that is. And what you're looking at here is my family. Pretty much everybody here has moved to Monroe over the last 5 years. So you've got my grandparents who live at Greenbrier at Whittingham, my mother who bought the house right behind them at Greenbrier, my in-laws who live at Regency, and my sister, my brother-in-law, who basically moved off of Spotswood Gravel Hill as well too. So we're lifers now. Yeah, I am a blessed man, without a doubt. Everybody's close by, and I grew up in North Bergen, New Jersey, and we've married the girl who sat behind me in homeroom, and she's the mother of the kids right now. So she's the battery that keeps everything going. I don't know how much Len might have shared about me before, and I don't want to spend too much time talking about, basically what we are, but I guess I haven't done the last count. I think I'm one of about 50 in the country, active practicing estate planning attorneys, as well as certified financial planners. There's not a whole bunch of us out there. I personally enjoy doing the holistic planning. I like knowing what the tax ramifications are, as well as the legal ramifications. And then I get frequent requests because I think Len's on my email newsletter list. Some of you some of you might also be, but we try to keep the community up to date. And if you're on Facebook, you're welcome to like our page, because we basically post almost an update a day. And it's very, our whole goal is educate to motivate. So it's very information based, not very spammy or salesy or anything like that. So feel free to check us out if you wanted to. And we do have a YouTube channel. I know you have a YouTube channel as well too, because I was on your YouTube channel earlier today for the Stonebridge group. But feel free to check out ours. I think we've got like 70 or so videos there, and we cover legal, tax, and estate planning. My mother's very proud, as my grandparents are, of the fact that I've been in different periodicals and the Wall Street Journal and all, but it's not really my why. When it comes to planning, and specifically when it comes to planning for my clients, I like to use this analogy of mountain climbing. I'm going to keep referring back to this. And in my story of mountain climbing, my heroes are my clients. They're the people that we serve, and that's what we're going to spend time talking about. So that's the mountain climber right there. But when I think of our team, and Julie's on the call as well too. Julie's our client success coordinator, but our team is really us. That's it. We're the Sherpas. So as our clients are the ones climbing mountain tanks, we're the ones carrying the oxygen tanks. We're the ones helping with the equipment. But the hero in these stories are always the families that we work with. I do suggest that as we go through this, it looks like some of you might be writing stuff down. Keep notepads, because I am notorious for making promises. Oh, you want a copy of our tax report? I'll send it out to you. You want a copy of that explainer sheet? I'll send it out to you. And then I tend to forget. But what we've started doing is after the webinar, and I could share it with you during the webinar, or I could send it to Len, and Len can pass it on if he wants to. We usually send like an after webinar sort of survey. And in the survey, you could request what it is you want to actually get from us, whether it's the tax report, the quarterly market update, or if you had questions that we didn't answer. Would that work, Len, if I sent that to you?
Sure.
Afterwards?
Whatever you want to do, Neal.
Okay, great. I'll send it over to you, and you can distribute it as you see fit, just whatever's appropriate. So, I'm big on analogies. And the story that I always come back to is there's this gentleman who's 300 pounds and is basically having foot pain. So he goes to the doctor and says, "Doc, I need a pill. I need something to make this better." And the doctor says, well, what's going on? He's like, well, I put weight on it and I just can't do any, it just hurts. So give me a pill. And he's like, so do you smoke? Oh yeah, I smoke. What about red meat? Like, yeah, twice a day. You stress at work? Oh, nonstop. I stress a lot. What about exercise? Like, I haven't exercised since, I haven't exercised since the 70s. So can I have that pill now? And that's not how medicine works. That's not how doctors work. And I think what you see too often is people with a particular type of pill using that to meet solutions. And we're going to talk about taxes. Taxes are one example of a pill. There's a lot of legal and financial tax-related pills out there. And just like any medication, you got to know the contraindications. So as I talk about trust today, we're going to be talking about how IRAs impact with trusts. As I talk about the tax law changes that are going to come up, we want to know how it's going to impact your legal plan, your estate plan, your financial plan, your long-term care plan too. And as we do this, we're going to try to keep an eye on the contraindications or the symptoms that we're trying to solve for and make sure that at least you've got an idea of what to look for. I don't think we're going to solve anything. We're not going to figure out how to what's going to happen with legislation in the next half hour or so that we have. But these are the 5 areas that I want to make sure we at least touch on during our time today. It's wills and trust planning. That's estate planning. We've got our tax planning as well. We've got long-term care protection planning. There is a tax element to that as well too here. Retirement income planning, which is definitely something that's changed a lot over the last couple of years, and investment planning. In fact, if I remember correctly, I think it was about 2 years ago when I came to speak, and it was right before the Secure Act was being introduced. Does that sound right?
Probably.
When I was at Stonebridge last. Yeah, and a lot's changed since then, and it looks like a lot more is going to change. I'm not going to spend a lot of time on this topic, but when we're talking about the difference between wills and trusts, that's a core foundational estate planning conversation. And just to kind of set everybody on the same stage, because I know some people have wills, some people have trusts. Everybody on this call should have something at this point. I always think of wills as a recipe. You might have a will which reads like a recipe, which is, look, I want a cake. So when I want a cake, if I ask somebody to give me a recipe for that cake, you'll give me the recipe. It'll take you 5 minutes to write it up. And then I'll go to Stop and Shop and I'll buy the eggs and the milk and the flour and whatever else I need, the sugar. I'll come home, I'll preheat the oven. I'll whip it all up into the oven and I'll stick a fork in it, make sure it's not sticking. And if it's sticking, I gotta put it back in. A recipe has to be followed. And a will is like a recipe in the sense that somebody's got to follow it. You got to go through probate with it. By contrast, a trust is like this. It's like baking the cake right now during your lifetime, putting the assets in the trust right now, so that when somebody passes away, there's no baking required or minimal baking required because everything's already been done for you. It's already aggregated in there. And when it comes to this sort of planning, and when I talk about the IRA specifically and how IRA distributions work out for the next generation, there's rules now, because what you'll see with a lot of our clients, or at least before they become clients, is they've got these trusts that they've set up. And in the trusts that they've set up, they may have IRAs and 401ks not integrated with the trust itself. Now, again, I'm going to talk about this in a little more detail later, but just know that if one of the goals for you or for anybody is, look, I want this IRA, this 401k that's going to ultimately be there for the kids, for the grandchildren, to go to my kids in some sort of protected vehicle where it's protected against divorces and lawsuits and creditors, it's probably not going to be enough to have the kids named as contingent beneficiaries. You're probably going to want to have some way for this Roth IRA to be integrated into the trust and then take advantage of this 10-year rule we're going to talk about in a little bit. Separately, but somewhat related, is this whole concept of what happens with long-term care planning. Now, most of you might know about this. And again, if we're having one-on-one conversations, I ask pointed questions. I ask nobody really share your private details during this phone call. But when we think about life planning, we talk about this mountain climbing analogy right now. Where I am right now, I'm 46. I consider myself in this accumulation phase. I still have to make money. I'm still basically earning income. And I'm basically working, and I'm going to get to this mountaintop at some point, and I'll get to enjoy the view. And at some point, I'm going to shift from working and being at this transition phase to actually living off of what I've earned. That's where I imagine that most of you are, either at this transition phase or at this distribution phase right now, living off of that. When you're climbing the mountain, most people say the goal is to get to the top, but where do most people get hurt? Coming down. Most people get hurt mountain climbing when you're coming down itself. And in the long-term care context specifically, this issues that are going to impact you when you get into this distribution phase when you're coming down the mountain is things like having enough income, that low interest rate environment market right now, and healthcare costs, and then long-term care costs. So why is this important in this topic? Obviously, we know long-term care costs is not cheap, and I'm not going to spend a lot of time on this either. This is 2019 numbers, pre-COVID numbers. $102,000 a year for a private room. You got medical inflation rate going up at 3.5%. So you're looking at about $150,000 a year, according to this Genworth study. In about 20 years, you're expecting it to be $200,000 a year. So if you think about how folks are working out, like why is the long-term care cost the way it is right now? You got higher demand, you got longer lifespans, you got family dynamics, and you got government. More people need it. People are living longer. Kids may not be able to take care of parents like they used to before. And now these Medicaid plans are going away or they're being diminished. Nothing's gone away, but it's getting harder and harder to qualify for those sort of programs because they're meant for the impoverished. And then we know what's going on with Alzheimer's, just illustrating the point that the need is there. Now, this is where the tax impact of this comes in. How do you pay for long-term care when you need it? And let me get all these up on the screen and I'll just talk about them for a sec. When folks that we work with are looking for paying for long-term care, we're looking at 3 different ways of paying for long-term care. One is you use insurance. You have long-term care insurance. And depending on the insurance that you have, it may or may not be sufficient based on what you have right now. Or it may have lapsed because it got too expensive. You may have reduced it because your premiums were going up. So the challenge with that insurance is, well, okay, it's going to help bridge the gap, but it's not going to bridge the gap completely. I'm going to have to take money out. And then we get into that hybrid version, which is the self-pay. So with the self-pay, and I'll go over some solutions on this in a second, but the self-pay is, you know what, Neal, I don't want to get insurance, and I'm probably not going to be eligible for Medicaid. When I need it, I'm just going to use my money for it. Now, where's that money that you're going to use to self-pay? Is it in a qualified retirement account? Because more and more, this is what I'm seeing. When I'm working with families from Stonebridge or Regency, or, you know, I got some people that are getting into Venue and all these 55 plus communities in our town, the self-pay option seems to make sense. But if I've got $800,000 in my IRA and I wind up having to take out $100,000 a year to help pay for my care, am I really getting $100,000 a year? No, you're not, because you're paying taxes on that money, especially if it's a traditional IRA, if it's a pre-tax account. And that seems to be one of the problems that I run into with self-pay clients often. The other aspect of it that I run into with self-pay is, how is it invested? What's the risk level on that too? If we're in a 2007, 2008, 2009 time cycle, and you've decided to self-pay, are you going to be able to pay with that? Are you going to liquidate an account at a very, very bottom of the market type situation? Or on the converse, what if it's sitting in a checking account and you're earning something like 0.1% on it? Is it going to keep up with that 3.5%, which is closer to 6% right now, healthcare cost of inflation? And that's one of the challenges that we run into with the self-pay option. And then finally, there are families that say, you know what, Neal, when I get to this point, I'm just going to give my stuff away to the kids. And when I give it away to the kids, I've no longer got it. Medicaid will help me pay. Not Medicare, Medicaid. Does that work? No, because they look back 5 years. And if you give your stuff away and you're looking at a 5-year window, you got to wait 5 years after you've given it away in order to basically qualify for Medicaid. Not to mention, if a lot of that stuff is in pre-retirement accounts, pre-tax retirement accounts, you're going to have to pay the tax just to give it away. So one of the solutions that we come up with, just to kind of address each one of these, is you want to know from a self-pay perspective, if that's your plan, A, how am I investing? Am I going to be bearing the risk of a market crash at this point if I had to liquidate it? And if it's really safe, is it too safe? Am I able to keep up with the cost of this long-term care? And then from an insurance perspective, this is one that's become more popular. It might be that many of our clients have actually bought whole life insurance policies or some sort of permanent life insurance policies when their kids were younger. And these might have a cash value built up in it, might have some sort of death benefit of a few $100,000, $300,000, $400,000. But they realize that that $300,000, $400,000, even $500,000 death benefit is not going to make that much of an impact on their kids' lives. But what would make an impact is if they had to stop and take care of us. So what we've done is something called a 1035 exchange, assuming that insurability is there. And it doesn't have to be like insurability for like a 40-year-old. Insurability for like a 75-year-old is fine in most cases. But we can do something like a 1035 exchange and take that existing policy that you have that doesn't fit anymore and possibly turn it into something with a long-term care benefit. So just something to throw out there. That is a tax-free exchange when you're looking at a 1035 exchange. And often you can turn life insurance into that. In some cases, you can turn annuities into that sort of long-term care benefit rider as well, too. So it's a good idea to take a look at what fits. Right now, under pending tax legislation, it didn't come up in these past acts. 1031 exchanges, which is the equivalent of those for real estate exchanges, have been targeted in the sense that not in this legislation, but they've been talked about in political rhetoric. So there's some thought that maybe 1031 exchanges might not be around forever. And if that happens, do these 1035 exchange options for life insurance and annuities and long-term care insurance also go away? We don't know. So we don't know if that option's always going to be on the table. So something to keep in mind if that's something that's not already addressed. Any questions so far? I know I said to hold up. All right, I'll keep going. You can throw something at me if anything comes up.
Yeah. What age are you talking about that you can do the 1035 up till?
I think the highest age that we've done, I want to say, was for a married couple. It was a seconded I policy that we moved in, and I believe the husband was 78 and the wife was 75.
Okay.
You may not get that full benefit. You might get partial benefits itself, but it would defray the cost of a long-term care. They also changed the rules a little bit during COVID because it used to be that you could just do a lump sum benefit, a lump sum premium payment instead of recurring payments. And then specifically about a year ago, when nursing homes were really, really in the middle of it all, they did away with that. They did away with that. Well, many of the carriers did away with that and wanted more of a recurring payment option. That's vice versa. They wanted a one-time payment option. They didn't want a recurring payment option, because they didn't want to take the risk of somebody paying one premium and then needing long-term care. But, it's a pretty quick thing to look into. So it's not something that you'd have to get physicals to see if you qualify at first. Just run numbers first to see if illustrations work on that too. I'm a fan. I've done this for my mother and for other family members as well. I'm generally a fan of not getting traditional long-term care insurance. I like something that would basically pay a death benefit to my beneficiaries if I didn't wind up using it. So for example, the one we have for my mother pays $8,500 a month if she were to get sick. Premiums are somewhere around $12,000 a year. But if she passes away and never having used it, there's a death benefit of about $300,000, $280,000 to be exact. So I'd look into hybrids like that. Those are what I prefer usually. Yeah. Looks like Gary's saying there's some feedback on there too. So if anybody wants to mute, or if anybody's got two microphones going or two computers in the same room, that might lead to the feedback sometimes. So tax planning for 2021 became a little more complicated because we obviously had the Secure Act, which we talked about, which changed the way RMD rules worked and which changed the way that the payouts work out there too. And then in 2020, we had the CARES Act. So that was in response to the coronavirus. And now we've got this it's a tongue twister, Build Back Better and other potential proposals. So let's talk a little bit about those and how those proposals might work. I'm always wary about speaking about proposals because you never know what's actually going to happen. But at the same time, it's always better to at least know what's on the horizon. There is a difference, though, between tax planning and tax preparation, right? When we're tax planning.
Excuse me, Neil. Can I just interrupt for a minute?
Of course.
Can everyone, except when you're ready to ask a question, just mute yourself because there is feedback. Gary has pointed it out. I've noticed it. It might be clearer. You can hear the speaker better. Just a suggestion.
Somebody's got a TV on in the background.
Yeah, thank you.
Got it. Let's give it a shot. And if it.
Okay, Neil. Thank
You
you.
still hearing it, or is it good now? All right, we can keep going, and you can let me know if you want me to stop again. So what I was going to say is tax planning, tax preparation. Difference with planning, we're looking ahead. This is the kind of stuff that we do before year end to figure out what we can do, when we can maneuver. Tax preparation, that's more like filing your 1040s. That's more like filing your tax returns at the end of the year. That's like keeping score, right? We were talking about the ALCS game or the NLCS game. By the time you get the score's over. That's what a 1040 is. But deciding who your starting pitcher is going to be, deciding whether you're who's going to be, whether you're shifting when the left-handed batter's up, that's all basically tax planning. That's proactive planning itself. So for 2021, this hasn't changed yet. Let me see. Are you able to see the screen right now? Was I blocking it before?
You're good.
I'm good. Okay. Looks like somebody's waiting in the waiting room. Is that possible? Let me see. Take a quick look. Here we go. Paul Goldberg was waiting in the waiting room. Got a notification. All right. So for 2021, there's still seven tax rates. You're looking at the 10%, the 12%, the 22%, the 24, 32. So you see these on your table right now. This 7-rate structure was created in 2017. This was under the Tax Cuts and Jobs Act under President Trump. What's scheduled to happen in 2025, or at the end of 2025, is we're scheduled to go from this 7 tax rate structure back to, I believe it was a 5-rate structure. That's going to be it's going to go back to whatever the tax rate structure was in 2017. So that's going to be a little bit more burdensome. So we talk a lot about, these proposed tax structures and what's scheduled to change, what's not scheduled to change. If Congress does nothing, if they just sit on their hands and just let what's supposed to happen, this existing tax law will sunset and we will revert back to what it was in 2017. So at the highest rate, we're looking at a 39.6 at that point. Now, that's something that's also proposed with the new tax law as well. So why is this relevant? Well, there's one thing that I see coming up really, really often with my clients, and this is going to be on the financial planning side as well as the legal planning side. And it's something I call the widow or the widower trap, which is a morbid topic. But, let's take an example here. If we were working with a married couple, and let's just say with RMDs, with Social Security, with any pension, investment gains, and anything that you have right now, you're looking at, say, $180,000, all right? So for a married couple filing jointly, $180,000 basically means that you're right here. You're in this 24% marginal rate, right? So every dollar that you earn over that $180,000 or over $172,000, I should say, gets taxed at 24%, plus New Jersey's tax. What happens when one of the spouses passes away? Now, some of the income might go down, but not all of it. Usually the RMDs will continue. Some element of Social Security is going to continue. The pension may or may not continue. But what happens is you go from being a married filer to now being a single filer. And then now with that same, let's just use that $180,000 figure, you're now looking at being in this bracket right here, this 32% bracket. And a lot of that has to do with the pain that comes with the RMDs and that taxable income. Now, this is under the 2021 tax rates. It gets worse under the 2017 tax rates that we're scheduled to revert back to. So one of the strategies that you want to be mindful of, and look, the idea is if that money's in an IRA, it's going to be taxed at some point. But if you can choose the tax rate, you're probably better off than letting the tax rate actually choose you. So you want to be mindful of what we do. And then I'm going to talk a little bit about Roth conversions, and I'll show you a tool that we use to actually calculate that stuff too. But something you want to keep an eye on is that widower penalty is going from a married filing status to a single filing status. That can have a pretty dramatic impact. So you want to do things that you can now to take advantage of the tax rates that you have right now. I don't know if everybody's aware of the QCDs because this is something that doesn't get a lot of press, but I feel like it probably needs a little more press. If you're giving $1,000 to a charity per year, the way that I see it done most commonly is I will take my RMDs, I'll put it in my checking account, and now after my checking account, I'll stroke a check to March of Dimes or the Red Cross or some other 501c3. Now, what's the problem with that? What did I do? I actually took the RMD out, I paid the tax on it, and now I cut the check to the charity. if I'm not above that threshold, or if I'm limited in my above the line deductions, or if I'm just taking a standard deduction, I did not get the benefit of that charitable gift. So qualified charitable distributions are a tool that everybody on this call has available to them if you're taking RMDs. Even if you're not taking RMDs, actually, you're allowed to basically have your check, if you will, go straight from the custodian to the charity. And that qualified charitable distribution will satisfy your required minimum distribution requirement. So instead of being taxed on making $100,000, you'll be taxed on making $99,000. So for somebody who's in that 24% bracket, you basically got a 24% rate of return on that $1,000 net, because you did not pay the tax, plus New Jersey's tax there too. So I do think that if you are doing any sort of charitable, you have a $100,000 maximum that you can give annually. But I think it's a very powerful tool. So if you're inclined to do anything with charities right now and you're taking RMDs, it doesn't have to be a whole lot that you're giving, but it's something that you definitely want to consider. Capital gains rates right now are still, you're still better off with the capital gains rate. I mean, we'll see what happens with this in the future itself, but you're still at the 0%, 0% up to a certain threshold. Again, this is some low-lying fruit here for some of you. If you've got gains built up in your portfolios, and if you don't have somebody looking at this for you, you really should have somebody looking at this for you, or if you're not looking at it yourself. But the idea is, as a married couple filing jointly, you can realize up to $80,800 in capital gains at a 0% rate. So any year that you've got gains built up and you're under that $80,800 figure, and you haven't bumped up and taken more gains that year, you might be losing some opportunities there. Take advantage of those capital gains. And by the way, we put together a tax report. It's we're drafting it right now. And if anybody wants a copy of that, we don't send it digitally. It's only a paper copy, but let us know if you want to keep a note of that too. That tax report, it's about 8 pages long, but a lot of these things are summarized in that tax report as well too. So we'll have it out there. But this is really like a great opportunity for those of you who may have capital gains built up, but you're not taking those gains right now because you might have, Amazon stock or Netflix or something where you've got a lot of gain built up. You don't want to take it, and you're not taking any gain as a result of that. Well, there might be an opportunity here to reset some of that. I won't spend a lot of time talking about tax gains and loss harvesting. It is something that you also want to keep in mind. There is some math involved with gains. So harvesting capital losses, that's a strategy that taxpayers, it basically is the taxpayer selling assets at a loss to offset gains. That's really all it is. And what we're trying to do is eliminate that capital gain. So let's just say that you were over that $80,000 figure. You've got losses, you've got gains, you want to wash them out. So you basically want to make sure that you're being mindful of how much you're taking in gains. And you'll see this a lot when we're rebalancing a portfolio. In the last few years, we've had a lot of people who've had substantial gains and they drift into a riskier portfolio because their equity portion is growing faster than their fixed income portion is growing. Well, now we try rebalancing them and we have to start taking some gains to rebalance them. Now it's time to start looking at some losses that we might be able to harvest for that too. So it seems like it works well, but sometimes it can only provide like a timing benefit. So you want to be mindful of it. Don't let the tax tail wag the dog, but at the same time, don't let the opportunities pass you by either. Yeah, I guess so again, they're highly effective, especially if you're at those higher rates. There is one thing that I always want to tell people is be careful of the wash sale rule. And if you're not familiar with the wash sale rule, basically you can't just sell Amazon, take the gain, and then within the next 30 days, sell it at a loss. Or basically, doing the same, whenever you're working with the same security within 30 days of buying and selling, you might be running afoul of the wash sale rule. So you want to be mindful of that. Don't, if you want to buy it, but there's ways to get around that, right? So if, depending on how attached you are to Amazon stock in that scenario, you might consider an option. You might consider a mutual fund that has heavily weighted on there too. But you want to be mindful of that wash sale rule because people do get dinged on it. Just be mindful of that. Again, I said I wouldn't spend a lot of time on this too, but if you want to take a note of this too, the tax report, if you keep an eye on, remind me of the tax report itself. Again, it's a mailing thing. I'll let Len know how to get in touch with us and Len can distribute it to everybody. So we'll get that over to you. this goes a little bit towards what I was referring to with respect to the the taxes and the widow and the widower trap itself too. Everybody's got some sort of family tax bracket. And what do I mean by family tax bracket? Well, I've got an IRA and I'm taking RMDs right now, and I'm in that 24% bracket. My son might be a high wage earner. He's in a 37% bracket. My daughter is in a 32% bracket. Who's better off realizing the income? Generally me. I'm in that lower bracket itself. So I think it's mindful when we're talking about this sort of Roth conversion conversation. Nobody likes paying taxes. I totally get that. But if we start filling up that, if you know what your family tax bracket is, sometimes this is an awkward conversation, but you want to speak with your family members about this. You want to speak with the kids about at least knowing what their tax bracket situation is, or at least suspecting that they're high wage earners. And if you can somehow have like this two stuff on the document that you write down, or the piece of paper that you write down, is what my marginal rate is and what my kids' marginal rates are, my beneficiary's marginal rate is. If I can be mindful of both of those, then I can start making determinations as to whether I should take income and maybe convert some of my IRAs into a Roth IRA, or whether it makes sense to leave it for my kids if they're not higher wage earners. But I think this family tax bracket concept, there is one big implicit assumption in this though. You got to care. If you don't care, and this is not a bad thing, it's not a judgy thing at all, but there are plenty of our clients who say, you know what, it doesn't really matter to me. If they wind up paying more in taxes, I'd rather just not deal with it. I don't want to pay the taxes right now. Or another philosophy is, you know what, if I pay those taxes right now, I don't get to earn on the money that I would have used to pay those taxes. So that compounding, I'd rather have that in my back pocket rather than pay the taxes today. So I'm not saying that it's a no-brainer, but I'm saying you should have an intentional conversation around it. You should be considering what the family overall tax bracket is going to be. So I did touch on this shortly, the IRA Roth conversions. And I don't know if you've talked about this in past topics itself, but with these IRA Roth conversions, effectively what we're saying is, look, I've got an IRA right now. It's taxable income when I take it out. I have the option to take all of it or chunks of it or a little portion of it and move it to a Roth IRA, pay the taxes today. And if I pay the taxes today, it'll never be taxed again, but it'll continue to be an IRA. It's a Roth IRA, and it'll continue to grow tax deferred. There's a few things that you want to be mindful of. Now, I'm going to shift screens for a quick second to see if I can bring this up. Hopefully I didn't close it. One of the things that we do when we're doing this analysis is we want to know, give me 1 second, if I can switch my share. We want to know what the impact of any Roth conversion is going to be. So we call this our tax report. And during our tax report, we'll actually look through the tax return to figure out what is that marginal rate of return. I'm sorry, what is that marginal tax rate? You want to know when you're doing a Roth conversion, a couple of things. You want to know obviously what your adjusted gross income is, what your taxable income is. You want to know what your average tax rate is and what that marginal tax rate is. And why is that important? Well, when you start realizing more income because you're doing a Roth conversion, you're going to start fiddling with other things as well too. So for example, a larger portion of your Social Security might get taxed. Instead of 50% of it taxed, it might be 85% of it that gets taxed. You also want to be mindful when you run that tax report of what, and again, it's not a huge thing, and it usually isn't a decision maker or breaker, but you want to know what your IRMA impact is going to be. Are we going to be is our Medicare premium going to be adjusted? And is it dramatic enough to stop us from doing it? Do we have losses carried over that we might be able to use to offset against some of that? So I would suggest that the Roth conversions, and I'll say separately in New Jersey, again, it's just a few $100s, but it does make a difference to some people emotionally, if not empirically. Am I going to lose a senior freeze? Like, am I going to have some sort of tax impact as a result of not having that as well too? So you want to be mindful and just know what all of that stuff is on the taxes before you do any Roth conversions. How is moving one piece going to impact all of my other pieces? So let me take a quick second there because I've thrown a bunch of information at you in a short period of time. Any questions so far?
Neal, what's the downside of converting to a Roth IRA?
Great question. What's the downside of converting to a Roth IRA? Well, before I get into that, one thing I didn't talk about is in some of these proposed legislations, one of the acts, there is a proposal to do away with Roth conversions or even backdoor Roth IRAs. If that happens, the theory is it wouldn't kick in until 2032. So what's the downside of converting to a Roth IRA? Well, if you're converting 100,000, for example, and I'm going to keep my math simple, and you're now paying taxes at a 24%, or let's just say 32% rate, and you've now paid $32,000 in taxes. The economic theory is that 32,000 can no longer work for you. So you might have had a compounding rate of return on that $32,000 as a result of not converting, because you would have had that money in the account. That's one. Secondly, because you're showing more income, that's when you want to know where this Medicaid surtax might be impacted, the homestead rebate, the senior free, some of that stuff. You might be showing more income. You might be deemed a high income earner. So most of the ramifications or the downsides of the conversion have to do with just higher taxation or moving yourself into a separate bracket, which is why you want to be mindful of your bracket management.
But
Does that
if
make
the
sense?
If the Roth IRA declines, let's say you took your money out of the traditional IRA and you bought a Roth IRA, but the Roth IRA did not do well and you lost money with it. That way you paid a tax on something and then you didn't get the benefit on the other side.
Morley, I would agree with you. You're probably right in that sense. The only sort of retort that I would have to that is, and this is more of an investment question, is if you do the math and you say, listen, even if I passed away the day after I did a Roth conversion, my next of kin, assuming it's my children, not even my spouse, because my spouse will still be able to stretch it out. My next of kin are going to allow that IRA to continue to grow for the next 10 years before they have to take it out. Because under the Secure Act, they're allowed to take it out over 10 years. And if you look at the worst decade for the market over a 10-year window, it was flat, right? So 2000 to 2009, say, the lost decade that everybody likes to call it, it's flat. So although you're right academically, and I agree with you, my philosophy on that is you really can't find a 10-year window when you're down. I mean, it's more of an asset allocation question as well, but does that make sense?
Yeah, well, that's why it's good to tell people that you want to put it into the Roth IRA and make it a diversified portfolio. You don't want to be concentrated in one area because that one area may not do well.
100% agree with that. I'll also, when you are doing a Roth conversion, I'm a strong believer in, if you have the cash outside of the Roth IRA, let the taxes be paid with money outside of the IRA and not the IRA money itself, because you're not going to be able to contribute to that IRA again. So might as well let the IRA continue to grow tax deferred in the Roth, but use your outside money to pay the taxes.
I have another question for you.
Sure.
Leaving an IRA to a younger child. Can you do that? And is there such a thing as custodian IRA?
It's almost as if you saw the slide on the screen and you laid me a softball here. So, which is great. I love it. So when you're leaving an IRA to a younger child, you can leave it to a child in trust. This is a big misconception. A lot of people think you can't leave it to in trust. You can, as long as within the trust you have what's called a designated beneficiary. So if you have a designated beneficiary and you're leaving the IRA to a child, most likely it's still going to have to come out within 10 years. There are some exceptions when you have a minor there to allow you to stretch out a little bit. But what most people want is when my minor child or my grandchild receives the IRA money, I want them to get it in a way that it's protected. So imagine that it's protected and it stays within this bucket. And yeah, it's not going to be an IRA after 10 years, but at least it's protected against things like divorces or them taking all of that cash over to a Corvette dealer and just buying a car with all of it. So with a minor child, I'm almost always going to recommend that how you have the IRA payable to a trust, and then you can have a trusteed IRA, a trusteed inherited IRA. Yeah, good question. Thank you for that. Looks like we're still getting a little bit of feedback, and I can't tell you who it is right now. But if you've got two speakers on, that might be the reason.
I don't know where that feedback is coming from, unless
It's not distracting me, so I'm fine with it. But just in case it's bothering anybody else.
Sounds like a
Right.
dog.
Morley asked a great question with respect to giving things to minors and gifting to minors too, right? One of the overlooked strategies, especially when you have kids who are going to college or even secondary schools in that matter, we want to gift to 529s. We want to gift, we want to gift to the children. We want to gift to them for whatever reason. It might be to take spring break. It might just be because you want to give them something with a warm hand. You're still allowed to give up to $15,000 a year to a person and to as many people as you like. So myself, my wife, we can each give $15,000 to my child, and we can give $15,000 to my grandchild each, so $30,000 when you put a married couple together. However, if you're giving to an educational institution on behalf of a child directly, you're not limited by that $15,000. Now, that's not a income tax deduction. That's just an exception to the gifting rule, where anything over $15,000 would require a gift tax return. So two different gifting rules, sometimes often confused. You can give $15,000 to as many people as you like. You can give it to your kids, your grandkids, nieces, nephews, lawyers. You can give it to anybody you want to. Don't give it to lawyers. But if you exceed that $15,000 to any one recipient per donor, then you've got to file a gift tax return. You got to let the IRS know that I'm not using that $15,000 rule anymore. I'm using some of my lifetime allowance of 11.7 million. That's the rule today, 11.7 million. In New Jersey, doesn't really care. New Jersey's got an unlimited amount. You could either give this away during your lifetime, that's the gift tax exemption, or you can die with it. That's the estate tax exemption. But you can't do both. If you give away $3 million during your lifetime, you're only allowed to die with 8.7 million. So under the legislation right now, one of the things that's targeted is possibly knocking that 11.7 million down again to 5.6 million. It's basically adjusted for inflation. If Congress does nothing, if they sit on their hands and we go back to the 2017 rule in about 3 years, then we're going to go back down to this dollar amount anyway. So this new tax rule would potentially just accelerate that and bring it back a little sooner. If you've got an estate that's larger than that, what counts in this? It's definitely your retirement accounts, your real estate, international assets count for this. Life insurance counts for this, as long as it's not in a trust. So a lot of things that you don't suspect sometimes do count against that too. Let me just do a quick time check here. All right, I can go a little faster on this too. So I talked about some of this. I'm sorry? All right, it looks like it might be Steve that's on. I just checked that. Steve, is it possible for you to mute yourself? Looks like your microphone's the one that keeps going off there. Not to name names, sorry. All right. So when we're looking at tax rates, what are we looking at? That 37% might go up to that 39.6%. That's one of those things that we're looking at under the tax proposals out there too. Also, the capital gains rate, which is now the highest rate being at 20%, goes up to 25%. For those of you who have trusts that are retaining income, that might be a problem as well. In fact, a lot of the trusts that we create are called grantor trusts, the irrevocable trusts, meaning that the grantor pays the taxes. If you had a trust prepared prior to this tax law change being done, it's probably time to give a call to your estate planning attorney. Say, hey, am I going to get dinged with this additional tax? Generally not going to be the case with revocable trusts. Irrevocable trust, you definitely want to have a conversation. There would be a potential another 3.8% plus another 3% tax on high wage earners too. So it starts adding up pretty quickly. You're looking at the highest possible rate for high wage earners being somewhere in that 46.4%. That's not even counting your state tax. That's just the federal component of it too. Some of these other things I can probably send afterwards. I want to make sure I leave a little bit of time for question and answers too. There is conversation about reducing the Roth conversion or doing away with it right away. Doing it away with it altogether. So maybe prohibiting, like we use a lot of backdoor Roths right now, which is basically clients will send in $6,000. We put it into a traditional IRA, and then we immediately move it into a Roth IRA. They pay the tax on that $6,000. Or sorry, it's already post-tax dollars. So the impact of that is it's a backdoor Roth IRA. Somebody who had too much money can now contribute into this Roth IRA. Well, they might be doing away with that. And I don't know if many of you follow this whole Peter Thiel story, founder of PayPal. Back in the day when he was starting PayPal, he put shares of his company in an IRA, a Roth IRA, and it's worth, I believe, something around $5 billion right now. So $5 billion going tax-free in a Roth IRA got some attention from Congress, and they don't want that anymore. So these mega backdoor Roth IRAs, if you have anybody or know anybody who does that, I know I've got one client who's actually got a business in an IRA, not quite mega yet, but want to be mindful of that too from a liquidity standpoint. They're going to start doing away with a lot of that stuff as well. Almost coming up on the end here too. Sensible taxation. Aside from that Build Better Act, there's a STEP proposal as well too. So this is a proposal not from Build Back Better, but this is called the Sensible Taxation and Equity Promotion Act of 2021, STEP. And this one's a little tricky because we talk about this Amazon shares. If I had this time machine and I go back and I find Jeff Bezos in a garage, he's got all his shares of Amazon. It's worth nothing. It goes up in value and it's worth $1 billion. Well, let's just use it more practical. Let's just say somebody's got shares of a mutual fund and it went from $200,000 to $1 million. You sell it, you pay gains tax on that $800,000 gain. But if I die owning it, my kids get what's called a step up in cost basis. So when they sell it for $1.1 million, they're only going to pay taxes on that $100,000 difference, that step up. Well, instead of that, this STEP proposal proposes that when I gift that stock to my children, I have to realize that gain of $800,000, not dying, just gifting. And when I pass away, my kids would mandatorily have to realize that gain. So effectively doing away with any of that step up in cost basis too. We're keeping an eye on it, just a proposal, but we want to know, I get this question all the time. If a proposal does come through, how soon is it going to be effective? Is it going to be effective immediately or is it prospective? And we don't know is the answer. The Build Better Act, the one that's in the House of Representatives, was introduced in September 13th of this year. It's possible that it can be made effective as of the date of enactment. There's some people that think that you might be able to go back in time and make it retroactive to January 1st, 2021. I don't see that happening. But if anything, I think the more likely scenario is it'll be effective either as of September 13th when it was introduced, or when it gets enacted, or some date in the future, like January 1st, 2022. So I know we wanted tax impacts. I'll talk a little bit about the market stuff, but not really actually. So there's a lot of information in here about market outlook and markets, and I don't want to spend too much time on that too. Just know that if you've got money in CDs, if you've got money in money markets, and those are your safe money, you're paying taxes on that money, and you're not earning anything on it to begin with. So even that 0.15 that you're earning on that 12-month CD, it looks worse. It's worse than it really is. You just want to be very mindful of that too. So not really a whole lot to say there. I'm just looking to see if there's anything else that I want to make sure that we cover before we open up to questions, but I think we pretty much got most of it. Key tax planning strategy. Let's just close on this here. This is a summary checklist. And as I mentioned, we have a more detailed one of this that we can send out to you. But I do think that as part of your tax planning, you do want to have an eye on these particular items. What is the bracket that we're in? What is the bracket that our family's in? Are we looking at our gain and loss harvesting itself? Are we itemizing our deductions? Or are we taking the standard deduction? Are we looking at QCDs? So again, I've got a more built out checklist here. Couldn't get it all on a slide, but this might be something for you to consider as you're doing your year-end tax planning itself, while some of these tools are still available to you. So with that said, I mean, you guys know what we do. We are tax planners, we are estate planners, we are financial planners. I'll include the link that's in here. I think most of you know me at this point, or at least we've spoken at some point in the past. So there's a link that I have that I can include in the chat group. You're welcome to use it to schedule a time to speak with us. And if you're interested in going further, we can do that. But aside from that, if anybody's got any questions, I'm all yours. Hope this was helpful.
I've got a question for you, Neal.
Go for it.
Let's assume I've got 20 children and grandchildren. I can give $30,000 each between my wife and myself to each of them. They take that money and they put it into a company. start a new company, an investment company. They take that money, they put it into the investment company. Whatever income it generates, they get their share, their distributions, and they give that back to me to live on. What's wrong with that?
So let me understand the scenario again. You gifted them $15,000 to these 20 grandchildren. After 20 grandchildren, I'm surprised you still have that money left, but that's
No,
a story.
I only have 6, but I'm making the numbers easy.
Okay, right. So 20 grandchildren, you gave them $15,000 a piece. They decided to start a company with that $15,000 a piece, and they contributed to a company. Did I get that right so far?
Yeah, they start the investment company with that money, yeah.
Mm-hmm.
And actually, we put 600,000 because my wife, myself, that's 30 times 20 is 600,000. And I can do this every year as long as I have the money to do it. But my question is, so now I have to live off this income. So they each get a distribution of income, return, and they give that to, they'll have to give 15,000 each to me to live on. Does that make sense?
It's a little circular. It makes sense. I don't know what exactly you'd be accomplishing by doing that.
Oh, I'm reducing my estate, and I'm reducing the estate, but I'm still keeping the income from the investments.
It works. If the goal was to retain income, but get it out of your estate, I don't think there is something called a step transaction rule in tax law that you can't do things in 2 steps or 3 steps that you shouldn't be able to do in 1. So that's one thing you have to be mindful of, but I'm sure there are creative ways to plan around that. But if the goal was get something out of your estate, but retain an income stream for yourself, I might consider something that's a little more straightforward, a little more proven. Something like a Grantor retained annuity trust might be something that you want to look into, because that actually allows you to get income flow from the trust and get a large chunk out of your estate. That's just one strategy there too, because when you deal with things like LLCs and holding companies, you have formalities, obviously. There's some administrative work, but when they're taking distributions from that $15,000, is it a return of capital? Are they getting K1s for those income distributions? So it gets a little convoluted with those. So I'm not saying it wouldn't work. I'm just saying there might be simpler ways to do it.
I mean, it just seems that it's not illegal to do that.
I don't know if I'd go to the level of illegal. I don't know if the juice is worth the squeeze, is my point. I think there might be.
I just thought about that and figured I'd bounce it off you.
Yeah, it's a fun way of doing it for sure. And we do a lot of that stuff with irrevocable trust too. But I think like anything else, morally, it probably comes down to, okay, what is it? If I'm living off of $15,000 a month, if my wife and I are living off of $15,000 a month, and that's what I need right now, how do I make sure that I've got that $15,000 a month? And if I don't want to touch my principal, then how do I make sure that that continues to work? And then we talk about, well, okay, if that's where my $15,000 is coming from, now I know that I could use this structure, whether it's an LLC or a particular type of trust or something different. I like brainstorming though. I like creative ideas.
What is Beacon? Can you say a little bit about that?
Yeah, for sure. So you'll see often with my company, it's Shah Total Planning. And Shah Total Planning is my umbrella company. But for compliance purposes, I've got separate companies. I'm the 100% owner. Beacon Wealth Solutions is a registered investment advisory firm. That's my RIA, registered investment advisory firm. That's where we do our wealth management and our financial planning. Shah and Associates is our law firm. That's where we do our legal strategies and our estate planning and our trust and estates work. Shah Total Planning is how we market ourselves, quite frankly, as one-stop solution. And the tax strategies are usually a combination of the two. We'll take legal strategies, financial strategies, and put the tax strategies together with them. But for compliance purposes, my financial planning firm, my RIA is regulated by FINRA, and my law firm is regulated by the bar.
Who's the custodian for Beacon?
I am a 100% independent registered RIA, so I custody my clients' accounts at either Charles Schwab or at Fidelity.
Okay.
Mm-hmm. Yep, but I'm a 100% independent. No broker dealers, no conflicts of interest. 100% fiduciary all the time. So I did in the chat group leave the link to our contact info, and I'll send it on to Len as well. But hey, I hope this was helpful. I know when Len reached out, he wanted to have something that was more tax heavy, meaning how we were mirroring the tax impact with investments. And So I try to keep that the focus, and I try to keep the focus towards potential changes in the future as well. But if anybody has anything else that they want to ask or anything they want information about in the future, I'm in town.
When do I
Gary,
have,
did you have any questions? Gary?
Oh, it was a very good presentation. I'm good.
Thanks, Gary.
I've got another question since nobody else
Sure.
has.
Yep.
When is the time that the tax laws have to be voted on?
And they have to be voted on?
You know, when they have to, they don't have till the end of the year, do they?
Not necessarily. So it's been before the Ways and Means Committee for some time. And then if you remember, we had this this budget that needed to be worked out. So that kind of diverted a lot of attention towards Congress. I suspect if it's anything like what happened in 2017, and then if you remember when we went over we were going to go over the fiscal cliff back in 2009, past history indicates that when it comes, it kind of comes out of the blue. It's not one of these things where they broadcast, hey, we're about to make changes, we're about to make changes. It's just all of a sudden, hey, here we go, we're done. So I guess that's a long way morally towards saying, I don't know. I don't exactly know when it's going to happen. It's Congress has its own pace, and there's some political maneuvering that needs to happen here. I believe that as we get closer and closer to the November elections, I suspect something would happen right after that. I can't imagine something's going to happen right before. That's a complete guess, though, on my part.
Are there any other questions?
And find out where that feedback's coming from and don't let them on anymore. Amazing that Neal could have kept his composure and his thoughts when we're hearing that in the background.
I had you guys on mute the whole time. I don't know what you're talking about. So just joking.
Neal,
Yeah, I have no idea where the noise is.
Yeah, I think somebody was going to ask a question there.
Neal, can you comment about when it's appropriate to place a home in a family trust?
Yeah, that's a great question. When is it appropriate to place a home in a family trust? It's a little bit of it's a longer answer. So to know that, I'd have to know what the long-term goals are, right? Like I'm not one of those guys who goes to Home Depot and buys a bunch of tools, then comes home and figures out what I want to build. Right? So what is the purpose of putting the home in a trust? You basically are going to put the home in an open bucket, like a revocable trust like this, because you want to avoid probate. When you pass away, you want the house to go in a straightforward way. That's one reason to put the home in a trust, and there's no bad time to do that. Some folks want to be eligible for Medicaid because your other assets allow for that. So for that, you might have a closed bucket, like an irrevocable trust, and move your house in 5 years before you need it, because you don't want that house to count as an asset against you, or you don't want a Medicaid lien being put against that. So that's a second reason for putting it into a trust. And for that, it would be 5 years before you need it. And then for another reason to put a home into a trust is, hey, this house is worth $700,000. I don't want it to be part of my taxable estate when I die. So let me put it into the trust, close it up, so it's also an irrevocable trust, and make sure that I put it in at today's value so that when it goes up in value, that's not going to be part of my taxable estate. Or if Congress takes away my right to put it in here, I want to be grandfathered in with that too. So I would identify the goal first. Are we doing it for estate tax planning? Are we doing it for asset protection planning? Or if I'm in a profession that's highly likelihood of being sued, I want to get it off of my balance sheet so I don't get sued. The best time to do it is right before you die, right before you get sued, right before you get sick, or 5 years before you get sick. But I think the first thing to identify is why put it into a trust at all. And then you could identify what your right time is to do it. I didn't want to be coy with the answer. That's a very lawyerly answer. So, but I wanted to give you all the details too, because there are a bunch of different vehicles that people will use for that.
What about the taxes in a living trust? Is that different than individual taxes?
The trusts that we use more often than any other trust are like wills on steroids. Those are revocable trusts. I keep using the analogy of an open bucket itself. So revocable trusts don't have a separate tax ID number. They don't have a separate tax filing. In fact, on your 1040s, you won't even know that you have a revocable trust. The irrevocable trusts that we use, many of them are what we call, and I hate this term, and you'll know why in a second, they're called intentionally defective grantor trusts. And try telling your clients you're doing something defective for them. It doesn't work out very well. But they're called defective grantor trusts because even though it's an irrevocable trust, it's the grantor who pays the taxes on it. So from an income tax perspective, you're in the same position you would have been otherwise. The trusts where the taxes are worse, for lack of a better term, are called non-grantor trusts. And they hit the highest rate, that 37% rate, when you have $13,000 of income. So those are the ones that you have to do some more tax planning around. Make sure that the income doesn't stay in that trust if you have a non-grantor trust. It's weird because I finish answering the question and then I hear myself for a little while afterwards.
Michael Bauer, do you have any questions? Michael? I guess he's frozen.
Right.
All right, well, if there are no questions, thank you for coming, and thank you, Neal, for presenting. And hopefully I got the recording okay.
Thank you for having me.
All right, and
Great meeting you, everybody.
we'll be in touch. You'll send me an email and then I'll distribute it to the investment club.
Sure. Yeah, I'll send you some follow-up information. But in the meantime, everybody stay safe and happy trick-or-treating.
Thank
Neal,
you.
where's your office? Where are you located?
Forest Gate Drive.
Oh, in Fort-
Yeah, I'm in Jamesburg. If you know the old Jamesburg High School building where the new Quick Check is, we're in the Forest Gate Commons right next to it. Yeah, been there for about 10 years, and this is year 21, me doing this. All right.
Okay, thank you, Neal.
You're very welcome. Everybody have a great evening. See you
Thank you.
soon.